Right. So what we're going to talk about today is a theoretical model on investor sentiment. So first, let's review the empirical evidence we have seen last time, beginning with the very famous study by Shiller. So the dotted line, as we said last time, the dotted line is the exposed just divided stock price based on dividend, and the solar line is the actual indexes. One is Dow Jones, one is S&P 500. So as you can clearly see, actual stock price is a lot more volatile than what you would justify with exposed dividend. So given that income stream from stock is not very volatile, what is driving the variations in stock price that we see from day to day? Okay, so another piece of evidence. Now, using Terence Odine's data on discount brokerage, if you look at the correlation between different portfolios, you look at the correlation between different portfolios formed from the data, you would see that investors tend to buy and sell at the same time. So the trading records within the portfolio happens with high correlation. When you see a buy in a particular time period, chances are there are a lot of other buys at the same time period too. And the same goes for sell. The correlation, as you can see, is pretty high because this diagram only shows from 0.4 to 0.75. So it's and you see a lot of that happening in this region. That's very high correlation. So it has predictive power. So this correlation you can actually use to predict stock movement. We have talked about that last time. And then we have the closed-end fund puzzle, which is the fact that closed-end funds typically sell at a discount from their net asset value. So I hold like $50 worth of HSBC. My fund is only selling for $45. Now, why would that be the case? So there are several pieces of the puzzle. One of the very important one is that fact that the discount is not constant. So the discount rate actually fluctuates a lot. So sometimes for the $50 worth of HSBC it would go for 45. Sometimes it would go for 40. Sometimes it would go for 49. What is driving that? And this discount shrinks or even disappear when the fund goes open-ended. So if I now allow you to redeem the underlying asset, then the discount disappears. Right. So these are diagrams showing that. The vertical line is when the fund announced that it's going open-ended. Right. So just to conclude, to explain the closed-end fund puzzle, you can use this model of noise trader risk, right? Closed-end funds have a higher fraction of individual clients than the overall market. This is something you can easily verify with data. If you have access to these type of data, then you can verify who is interested in these type of funds. So they have more individual investors, and we know individual investors are more susceptible to settlements, right? They tend to do things together. Individual clients are less rational for that reason. So that makes closed-end funds more risky than the overall market. So resulting in them selling at a discount, right? These funds are purchased by small investors who are more likely to have variations in whether they want to buy and sell. So that adds risk to the market, and risk means they have to have a higher return. How do you get higher return for the same asset value? Lower price. Okay. Higher return means lower price. This is the thing that you have to, that for people who haven't learned finance, they sometimes have a hard time to grasp, right? Remember, bond prices. Yield goes in the opposite direction as price, right? When bond price goes down, bond yield goes up. That's how it works. That's because in bonds, you are paid back the face value and the determined coupon rates regardless of the price, which makes the return higher when the price is lower. And we explain why the discount is not being arbitraged away, because you have all these noise traders, individual traders buying this asset that has higher return due to risk. Higher return helps people survive. So it might not be arbitraged away at all. So the four-part puzzle is explained. Overall low valuation due to demand from noise traders. They add risk, lower price. The initial high valuation is due to a market timing, not particularly in the model. This is a separate model that we probably don't have time to talk about. Wide fluctuations in value due to fluctuations in sentiment. And shrinking of discount is that when you pool the two types together, think about what happens if you, instead of having a risky asset and a risk-free asset, you only have a single asset. Then there's no separation of market, and everything gets washed out by more. In particular, if you think about it as having only the risk-free asset, right, which has infinite supply, it doesn't matter that the noise traders misprice, because there's infinite supply. When there's infinite supply, price never goes up beyond their underlying value, right? So this is what happens when you have a closed-end fund that's open-ended, right? Because you're essentially joining a much bigger market, which effectively have kind of like very, very large supply, keeping prices at close to their real value. All right, so okay, I think that's it for this topic.